Hi everyone, we're Group 20 and today we'll be presenting our analysis on Qantas Airways. So we'll start with an overview of Qantas's business model, then move into the types of exchange risk that it faces. After that, we'll discuss the financial and operational hedging strategies that Qantas uses to manage these risks. And finally, we'll finish with our evaluation and recommendations. So I'll begin by giving a quick overview of Qantas's core operations and their main sources of revenue. So to first understand Qantas's financial risk, it's actually important to first look at its core operations and where its revenue comes from. So Qantas runs a domestic and international network serving routes across Australia, Asia, the US, Europe, and the Middle East. Passenger services are split between Qantas Airways, the full-service airline, and Jetstar, its low-cost subsidiary. Together, these brands capture different segments of the market, from budget travel to premium long-haul flights. Qantas also generates revenue from premium services like lounges, Wi-Fi, and priority boarding. And the group also has a strong freight and cargo division, which actually became particularly important during COVID and continues to diversify revenue streams. Then there are ancillary services such as Qantas Holidays, hotel and car hire packages, travel insurance, and the Qantas Travel Money Card. So the most significant is actually the Qantas Frequent Flyer program, which has grown into one of Australia's largest loyalty schemes, and it brings in revenue not only from passengers but also from partnerships with banks, supermarkets, and co-branded credit cards. So this program alone generates steady, recurring income and is highly profitable. So overall, while ticket sales are still the main driver, Qantas's revenue is broad-based, which means it spans passengers, cargo, loyalty, and travel products. So Qantas's major operating costs are linked to forex movements, creating several key risks. First of all, fuel costs are benchmarked in US dollars, so when the Australian dollar weakens, every litre of jet fuel actually costs more in AUD terms. Qantas manages this with derivative hedges such as fuel options and collars, but unexpected oil price strikes can still bite. Aircraft leasing and purchase agreements are also mostly in US dollars, so a stronger US dollar makes lease payments more expensive. Qantas partially offsets this by holding USD revenue from international routes and also by using currency forwards. Labour and supply costs are mostly in AUD, but overseas maintenance contracts and international crews introduce smaller forex exposures. On the revenue side, international ticket sales bring in the US dollar, euros, and Japanese yen. If the Australian dollar strengthens, those foreign revenues actually translate into fewer Australian dollars. So even with hedging programs, residual risks still remain. Overall, Qantas's profitability is highly sensitive to movements in the Australian dollar to US dollar rate and to global fuel prices, making active hedging and matching of US dollar revenues against US dollar costs critical to managing its international finance risk.
Given Qantas's international operations, the company is vulnerable to exchange rate fluctuations. Each of these risks present distinct challenges for the airline that affect its financial performance and market competitiveness. Qantas experiences transaction exposure through its reliance on foreign currencies. Transaction exposure arises when exchange rate fluctuations affect the value of financial transactions. A major source of transactional exposure for Qantas is fuel expenses. Fuel for the airline is commonly purchased in US dollars under long-term contracts. When the Australian dollar weakens, the cost of fuel increases, raising Qantas's operational costs. As one of the airline's largest costs, minor fluctuations in the exchange rate can have a large impact on the company's profit margin. Leasing contracts also contribute to transactional exposure. Many of these contracts are in foreign currencies like US dollars or euros. Changes in the exchange rate can result in Qantas paying more for assets such as aircraft when the cost is converted to Australian dollars. This risk can affect Qantas's performability, especially if exchange rate fluctuations are unpredictable or the company has long-term leasing agreements. Economic exposure has a broader long-term impact on Qantas's market value and international competitiveness. It reflects how ongoing fluctuations in exchange rates influence the company's future cash flows and revenue. When the Australian dollar strengthens against other currencies, foreign customers find Qantas flights more expensive, making the airline less competitive compared to other international carriers with lower prices in the foreign markets. This can lead to a decline in international bookings and their market share. Additionally, when Qantas earns revenue in weaker foreign currencies, the value of that revenue declines when converted back to Australian dollars. This erodes profitability, especially when operating in multiple markets with depreciating currencies, even if there's stable growth in sales. Translation exposure arises when a business consolidates its foreign assets and liabilities into local currency for financial reporting purposes. This doesn't impact cash flow, but it does impact the company's reported earnings. As an international airline, Qantas has a lot of foreign assets, investments, and liabilities. When the value of foreign currencies changes, so does the value of these assets. Although translation exposure doesn't affect operational liquidity, it can cause significant changes in reported profits. This in turn can impact investor confidence and share prices.
Now I'm going to talk about Qantas's financial hedging strategies and how the company manages its exchange rate risk. Qantas operates globally, so it earns revenue in many different currencies such as US dollars, euros, and yen. However, most of its major expenses like jet fuels and aircraft leases are paid in US dollars. This mismatch means that when the Australian dollar falls, Qantas's costs go up in local terms. To protect itself from this uncertainty, Qantas uses financial derivatives to stabilize cash flows and keep its profit margin steady. One of the most common tools Qantas uses is a forward contract. A forward contract allows Qantas to lock in today's exchange rate for a future payment, so even if the currency changes later, the cost stays the same. Qantas mainly uses this for fuel and aircraft lease payments. This reduces uncertainty, but the downside is that if the Australian dollar strengthens later, Qantas can't benefit from the better rates. For example, Qantas expects to pay $500 million for jet fuel in 6 months. It enters a forward contract at 0.65 AUD per USD, which locks in the cost at today's rate. Even if the US dollar becomes strong later, Qantas will still pay at the fixed rate. So this strategy secures costs but offers less flexibility. They gain stability but lose potential saving if the exchange rate moves in their favor. Another tool is currency options. A currency option gives the right but not the obligation to exchange money at a certain rate before a set date. This lets Qantas protect against unfavorable currency movements while still keeping the upside if the rate becomes more favorable. For instance, Qantas can buy a USD call option that allows it to purchase dollars at 0.65 AUD per USD. If the dollar strengthens, they can use the option to save costs. But if the Australian dollar strengthens instead, they can simply let the option expire and benefit from the better rate. The only downside is that options are more expensive because of the premium cost. Qantas also uses currency swaps, which are long-term agreements to exchange cash flows between two currencies. In this case, Australian dollars and US dollars. For example, Qantas might swap its AUD revenues with a bank to receive USD payments over several years. This is especially useful for aircraft leases or financing that lasts a long time. Swaps help Qantas match its USD expenses with stable AUD income, but they can be complex and involve counterparty risk if the other party defaults. Even with these hedging tools, managing currency risk isn't easy. Market volatility can affect how effective the hedge actually is, and it also depends on accurate forecasting of future revenues and costs. If those estimates are wrong, the hedge might not match perfectly. On top of that, there are complicated accounting and compliance rules that make these strategies costly and time-consuming to manage. So while Qantas's hedging reduces exposure to currency risk, it can't fully eliminate it.
Natural hedging is a risk management strategy that uses a company's own operation to offset risk such as foreign currency or commodity price fluctuations, instead of relying on financial instruments like derivatives. For example, a business can hedge naturally by earning and spending in the same foreign currency, or by setting up a subsidiary within that market. Qantas applies this approach because many of its international operations, such as fuel purchases and aircraft leases, are priced in US dollar. When the Australian dollar strengthens, the cost becomes cheaper in local terms, helping to stabilize expense and reduce the financial impact of currency swings. Additionally, Qantas Freight Division and Loyalty Program provides further natural hedges, helping smooth earnings during market downturns and supporting consistent financial performance and investor confidence. Qantas uses natural hedging by matching its USD income with USD expenses. For example, international flight and freight services generate significant USD revenue, which Qantas uses to pay for jet fuel, aircraft leases, and maintenance, which are all priced in USD. Similarly, Jetstar Asia earns and pays in Singapore dollars, creating a local hedge. This alignment reduces foreign exchange risk and stabilizes profitability. Another key natural hedging strategy used by Qantas is diversifying its operations. Qantas earns revenue in several currencies, including US dollar, Japanese yen, British pounds, and euros, through its global route network. The mixture of currency helps spread the airline's exchange rate exposure. Subsidiaries like Jetstar Asia, Jetstar Japan can also play an important role by earning and spending in their local currencies, which create natural regional hedges. Overall, the diversification can help Qantas balance fluctuations between currencies and maintain a more stable earning even when one currency, such as Australian dollar, moves sharply. Leading and lagging is another strategy that Qantas can use to manage exchange rate risk. Because many of Qantas's major costs, like fuel and aircraft leases, are in the US dollar, the company can lead payments if the USD is expected to rise, or delay payments if the AUD is likely to strengthen. For example, if the Australian dollar is forecasted to fall, Qantas might pay US suppliers early to avoid higher costs later. This approach provides flexibility, but it depends on accurate exchange rate predictions and strong supplier relationships. Matching revenues and costs is a simple and cost-effective strategy. Qantas uses US dollar from international flights and freights while paying major expenses like fuel and aircraft leases in the same currency. This helps offset exchange rate risk, although it's hard to perfectly match the timing or amount. Secondly, diversifying operations spreads Qantas' income across many currencies, reducing reliance on any single market. This adds stability but also increases management complexity and doesn't fully eliminate the company's USD exposure. Lastly, leading and lagging gives flexibility by adjusting payment timing based on exchange rate expectations. It is a low cost and effective in the short term, but depends on accurate forecasts and might even strain supplier relationship if it is used too frequently.
Starting with financial hedging, tools like forward contracts, currency options, and swaps are highly effective for providing short-term certainty. By locking in exchange rates for future jet fuel or lease payments, Qantas can accurately predict its costs and protect profit margins from sudden AUD and USD movements. This is especially valuable in the airline industry, where margins are thin and costs are largely foreign-dominated. For instance, according to Qantas's 2023 annual report, the airline hedged around 60% of its expected fuel costs using forward contracts and options. This shows how central financial derivatives are to its risk management framework, particularly for large USD-dominated expenses like jet fuel and aircraft leases. Financial hedging limitations. The main limitation is that financial derivatives are expensive and rigid. Forward contracts remove flexibility. If the Australian dollar strengthens, Qantas can't benefit. Options give flexibility but come at a high premium cost. Swaps help align long term payments, but they're complex and carry counterparty risks. Additionally, hedging outcomes depend on accurate forecasts of revenue and expenses. If estimates are wrong, the hedging may not perfectly match the exposure. So while financial hedging stabilizes cash flows, it can't fully remove exchange risk rates and may reduce Qantas' competitiveness if used too heavily. Operational hedging. Operational or natural hedging works through a company's own operations instead of financial derivatives. It involves balancing revenues and expenses in the same currency or spreading exposure across regions to reduce exchange risk rate. Qantas applies this by using its global operations to naturally offset currency movements. For instance, matching revenues and expenses. Qantas uses USD income from international flights and freight to pay USD expenses like jet fuel, aircraft leases, and maintenance. This creates a built-in hedge that reduces exposure to AUD and USD movements. Second is regional subsidiaries operating in local currencies. Subsidiaries like Jetstar Asia and Jetstar Japan earn and spend in their local currencies. This provides regional diversification and limits reliance on the Australian dollar. Third is currency matched financing and leases. Qantas funds some aircraft through USD loans and leases tied to its US and international routes. This ensures loan repayments are made in the same currency that the revenue is earned. The fourth is leading and lagging payments. Qantas can adjust payment timing depending on exchange rate forecasts. For example, it pays suppliers in USD earlier if the AUD is expected to fall or delays payments if it's likely to rise. And lastly, diversified global operations. Qantas earns across multiple currencies, which involves USD, JPY, GBP, EUR, and SGD through its international network. This spreads currency exposure and smooths earnings when one currency weakens. Operational hedging limitations. The first is timing mismatches. It's hard to perfectly align when foreign revenues are received when expenses are paid. This means some exposure remains even with matching strategies. Second is complex coordination. Managing multiple subsidiaries across currencies like USD, JPY, and SGD adds administrative complexity and can lead to inconsistencies. Third is forecasting limitations. These strategies rely on accurate exchange rate predictions. If forecasts are wrong, timing adjustments like leading or lagging payments may backfire. Fourth is incomplete coverage of USD exposure. Qantas still has heavy USD expenses for aircraft and fuel. Natural hedging reduces risk but can't eliminate it completely without financial instruments. Overall, while operational hedging is cost-effective and sustainable, it's less precise and takes longer to adjust. That's why Qantas combines it with financial hedging for stronger overall protection. Based on a contrast hedging strategies when comparing the two, we can see that the financial hedging offers short-term control but higher cost, while operational hedging provides long-term stability but less precision. The most effective approach for Qantas is that therefore a hybrid model that integrates both methods is most strategical. To improve its exchange rate risk management, Qantas could strengthen its natural hedge by expanding USD-based routes and freight contracts to balance ongoing USD costs, align borrowing and leasing in USD to match major expenses, give subsidiaries like Jetstar greater independence to manage revenues in their own currencies, and use advanced FX forecasting tools or AI-driven analytics to dynamically adjust hedge ratios as market conditions may change. Overall, Qantas' combined use of financial and operational hedging has been effective in reducing exchange rate exposure, but there's room to improve efficiency and flexibility. By enhancing natural hedging and relying less on costly derivatives, Qantas can achieve stronger, more sustainable protection against currency risks. Overall, Qantas's approach to managing exchange rate risk demonstrates a strong balance framework. Financial hedging provides precision and short-term certainty, while operational strategies deliver structural long-term resilience, yet limitations such as derivative expenses, imperfect matching, and exposure to USD costs persist. Enhancing natural hedging through greater USD revenue generation and implementing advanced forecasting analytics would allow Qantas to reduce costs, improve efficiency, and maintain a competitive advantage in volatile global markets. That concludes our presentation on Qantas exchange rate risk and hedging strategies. Thank you for listening.